July 1944. While American soldiers stormed the beaches of Normandy and Marines fought across Pacific Islands, 730 delegates from 44 nations gathered at the Mount Washington Hotel in the mountains of New Hampshire. World War II still raged with no clear end in sight, yet financial elites had already moved past the war to design what came next. For 3 weeks, in a luxury resort far removed from the front lines, they would reshape the architecture of global finance in ways that still control your economic reality today. What emerged from those meetings wasn't about preventing another Great Depression, though that's the story you've been told. The Bretton Woods Conference created something far more significant: permanent institutional infrastructure that gave central banks control over world money beyond the reach of democratic politics. The International Monetary Fund, the World Bank, the dollar-gold system that lasted until 1971. These were tools designed to solve a problem central bankers had faced since the 1920s. They could manipulate money within their borders, but international monetary flows kept escaping their grasp. The pattern you're about to discover reveals how every major crisis becomes an opportunity to centralize monetary control. Bretton Woods perfected the playbook. Understanding what really happened in that New Hampshire resort 80 years ago gives you the key to decode every proposal for international monetary reform you hear today. The story begins not in 1944, but in the chaos that central bankers couldn't control. Before World War I, the classical gold standard provided discipline that constrained what governments and central banks could do. Countries maintained fixed exchange rates through gold convertibility, which meant you couldn't just print money without consequences. Then the Great War arrived, and every major nation suspended gold convertibility to print the money needed to fight. They planned to return to gold after the war, but they made a critical mistake. They chose the wrong exchange rates. Britain decided to return to the gold standard at the pre-war parity in the mid-1920s, even though massive wartime inflation had fundamentally changed economic realities. Winston Churchill, as Chancellor of the Exchequer, made this decision despite warnings from economists like John Maynard Keynes. The result was predictable and devastating: deflationary pressure that crushed British industry and wages. Meanwhile, France returned to gold at a devalued rate, giving French exporters a competitive advantage that Britain had just surrendered. The Bank of England found itself trapped, unable to stimulate the domestic economy without losing gold reserves to France and the United States. The Great Depression transformed these tensions into open currency warfare. When Britain finally abandoned gold in September 1931, the pound devalued by 30% almost immediately. The United States followed in 1933, devaluing the dollar by 41% against gold when Roosevelt raised the official gold price to $35 per ounce. France held out until 1936, watching its economy suffer devastation while defending a gold parity that had become indefensible. Each nation tried to export unemployment to its trading partners through competitive devaluation, fragmenting international commerce into hostile monetary blocks: the sterling bloc, the dollar bloc, the gold bloc. Central banks faced a fundamental problem that no amount of technical expertise could solve. They could control domestic money supply, but gold movements across borders constantly undermined their policies. The Bank of England couldn't stop gold outflows without raising interest rates that would crush the already depressed British economy. The Federal Reserve couldn't pursue expansionary policy without losing gold reserves. Each central bank protected narrow national interests, and the collective result was chaos. But something emerged from this disorder that would prove more significant than the chaos itself. In 1930, governments created the Bank for International Settlements, supposedly to handle German reparation payments from World War I. The official purpose barely mattered. What mattered was that it gave central bankers a place to meet away from political oversight. Every month, central bank governors would gather in Basel, Switzerland, for coordination meetings that their own governments barely understood. These men, and they were all men, discovered something important. They preferred coordinating with each other over answering to politicians or parliaments. The BIS established a pattern that Bretton Woods would perfect 15 years later. Take a crisis, German reparations, and use it to justify creating a permanent institution that operates beyond democratic accountability. Dress it up in technical language that excludes non-experts from meaningful participation. Then watch that institution outlive the original crisis and expand into new areas. The BIS still operates today from the same Basel Tower, now coordinating central bank policy for the entire world economy. By 1941, before Pearl Harbor brought America into World War II, Central bankers and their allies and finance ministries already understood the opportunity ahead. War would devastate Europe and Asia, creating conditions where desperate nations would accept whatever monetary system offered reconstruction assistance. Two men positioned themselves to design that system: Harry Dexter White at the U.S. Treasury and John Maynard Keynes representing Britain. White had begun planning America's post-war monetary architecture as early as 1941, crafting proposals that would place the dollar at the center of world finance. His vision was breathtakingly ambitious: an international monetary fund that could enforce exchange rate discipline globally, and a World Bank that would channel reconstruction loans in ways that created permanent dollar dependence. What White understood, and what most people miss even today, is that whoever controls the international monetary system controls far more than exchange rates. They control the flow of capital, the terms of trade, and ultimately the economic sovereignty of every participating nation. Keynes arrived at these negotiations with his own plan, one that would have prevented any single nation from dominating the system. His proposal centered on an international currency called Bancor that would be managed by an international clearing union operating beyond the control of any national government. The Keynes plan included automatic penalties for countries running either deficits or surpluses, preventing the kind of global imbalances that had destabilized the 1930s. Most importantly, it would have required even surplus countries, including the United States, to adjust their policies when imbalances emerged. But Keynes was negotiating from weakness, and White held all the cards. By 1944, the United States controlled approximately two-thirds of the world's monetary gold reserves. European nations faced economic devastation that would take decades to repair, leaving them desperate for American capital. Britain itself was bankrupt, surviving only through American lend-lease assistance that could be terminated at any moment. When you control the gold and your potential partners face financial ruin, technical economic arguments matter less than raw leverage. The golden rule operated in its purest form: whoever has the gold makes the rules. White and Keynes spent 1942 and 1943 in private negotiations, hammering out the basic framework that would be presented to the other nations. This wasn't open multilateral diplomacy. It was bilateral deal-making between the world's two leading financial powers, with the stronger partner dictating terms. By the time the Bretton Woods Conference convened in July 1944, the major decisions had already been settled. The 730 delegates from 44 nations were largely presenting for ratification, a system designed in private by American and British officials. The public framework that emerged looked like international cooperation, but the hidden architecture told a different story. The dollar became the only currency convertible to gold, and then only for foreign central banks, not private citizens. Other nations needed to maintain dollar reserves to support their currency pegs, creating structural demand for American dollars regardless of underlying economic fundamentals. When the United States ran balance of payments deficits, the world absorbed those excess dollars as necessary reserves. When America needed to adjust its domestic policies, it could ignore international constraints because the world needed dollars more than America needed foreign currencies. The International Monetary Fund received authority to monitor exchange rates and provide short-term liquidity. But voting power was weighted by economic size. The United States effectively held veto power over any major decision, while smaller nations found themselves subject to policy conditions whenever they needed assistance. The World Bank created a parallel system of influence through reconstruction lending, requiring borrowing countries to use American contractors and equipment while building infrastructure that deepened their integration into the dollar-based trading system. Most significantly, both institutions operated through technical expertise that effectively excluded democratic oversight from member countries. Complex economic analysis determined lending conditions, exchange rate adjustments, and policy requirements. National parliaments could debate the results, but the crucial decisions were made by credentialed experts in international institutions beyond the reach of voters. What appeared to be multilateral cooperation was actually the institutionalization of American monetary hegemony, dressed up in the language of international technical management. The genius of the Bretton Woods system wasn't that it solved the problems of the 1930s. It didn't, and eventually it created new problems that destroyed the system itself. The genius was that it created permanent institutional infrastructure that would outlast the specific monetary arrangements. The IMF, the World Bank, the coordination mechanisms, the precedent for supranational economic management, All of this survived the collapse of the gold dollar peg in 1971 and continues operating today. The Bretton Woods system went operational in 1945, with devastating European economies providing the perfect laboratory for testing its control mechanisms. The dollar shortage that gripped war-torn nations wasn't an accident. It was engineered scarcity that gave the United States unprecedented leverage over the economic policies of sovereign nations. Britain's humiliating experience in 1947 demonstrated exactly how this leverage worked in practice. The British had negotiated a massive loan from the United States in 1946, with conditions that included making the pound convertible for current account transactions by July 1947. Within 5 weeks of implementing convertibility, Britain faced such massive capital flight that reserves evaporated and the government was forced to suspend convertibility again. The lesson was unmistakable. Even the world's second-largest economy couldn't maintain currency convertibility without American approval and support. If Britain couldn't challenge the dollar system, no other nation could either. The International Monetary Fund's true purpose revealed itself not in promoting exchange rate stability, but in enforcing policy conditions that transferred sovereignty from national governments to international technocrats. Countries seeking currency support had to accept what became known as conditionality, policy requirements that typically included cutting government spending, raising interest rates, and devaluing currencies to reduce imports. Social programs were cut, wages were suppressed, and unemployment was tolerated, all to maintain currency pegs in a system these nations had never truly chosen. This represented a fundamental transfer of democratic authority. Monetary policy, which affects every aspect of domestic economic life, was increasingly determined not by national politics, but by international coordination requirements. Central banks found themselves answering more to the IMF and the Bank for International Settlements than to their own parliaments. Exchange rate changes above 10% required IMF approval, giving foreign technocrats effective veto power over national economic strategies. Meanwhile, the United States enjoyed what French Finance Minister Valéry Giscard d'Estaing would later term the exorbitant privilege of the reserve currency country. American corporations could buy foreign assets with dollars that the Federal Reserve could create at will. The rest of the world accumulated these dollars as necessary reserves, effectively financing American deficits with real goods and services in exchange for paper claims. When other nations complained about American policies, Washington could ignore them because the world needed dollars more than America needed foreign cooperation. By the 1960s, this arrangement required increasingly desperate measures to maintain its credibility. Dollar liabilities held by foreign central banks exceeded American gold reserves, making the $35 gold price mathematically unsustainable. Rather than adjust policies to restore balance, the major central banks formed the gold pool in 1961, coordinating gold sales to suppress the market price and maintain the fiction of dollar-gold convertibility. The gold pool included Britain, France, Germany, Italy, Belgium, the Netherlands, and Switzerland, all working together to defend an exchange rate that served primarily American interests. When speculators finally overwhelmed the pool in 1968, forcing its abandonment, the central banks created a two-tier system, an official gold price for central bank transactions and a separate market price for everyone else. The system survived through increasingly obvious manipulation, revealing that technical management was really political control disguised as economic expertise. Then came the Nixon shock of August 15, 1971. On a Sunday evening, with global markets closed and no advance consultation with allies, President Nixon announced the temporary suspension of dollar-gold convertibility. He simultaneously imposed wage price controls domestically and a 10% surcharge on imports, forcing trading partners to choose between accepting a purely paper dollar or losing access to American markets. The Smithsonian Agreement of the December 1971 attempted to salvage the system through wider fluctuation bands and dollar devaluation, with Nixon proclaiming it the most significant monetary agreement in world history. It collapsed within 14 months. By March 1973, the major currencies were floating freely, and the Bretton Woods system was officially dead. But here's what almost everyone misses about the collapse of Bretton Woods. It didn't reduce central bank control over international monetary affairs. It intensified that control by making it less visible and more flexible. The floating exchange rate era that began in 1973 supposedly represented a fundamental break from Bretton Woods, but the reality reveals something far more revealing about how monetary control actually works. Fixed exchange rates disappeared, yet central bank coordination not only continued, but expanded and intensified through less visible mechanisms. The International Monetary Fund lost its role monitoring currency pegs, but gained something more powerful: the authority to manage currency crises through conditional lending that reshaped entire national economies. The 1980s Latin American debt crisis demonstrated this new power in action. When Mexico announced in August 1982 that it could no longer service its foreign debt, the IMF stepped in not just to provide emergency financing, but to impose structural adjustment programs that went far beyond the monetary policies of the Bretton Woods era. These programs required privatization of state enterprises, elimination of price controls, reduction of trade barriers, and reorientation of entire development strategies toward export production and debt service. The conditions were more intrusive than anything the IMF had demanded under Bretton Woods, yet they operated through the same crisis mechanism: use emergency conditions to impose permanent structural changes. Then came the Plaza Accord of September 1985, which revealed that major central banks could still manipulate currency values collectively whenever they chose. Finance ministers from the United States, Japan, Germany, France, and Britain met at New York's Plaza Hotel and announced coordinated intervention to drive down the dollar's value against the yen and Deutschmark. The operation succeeded dramatically. The yen appreciated by 50% over the next 2 years. Japan's subsequent lost decade of economic stagnation traced directly to this forced currency appreciation, demonstrating that coordinated central bank action could reshape national economic trajectories just as effectively as the old fixed exchange rate system. The Louvre Accord followed in February 1987, this time coordinating to halt the dollar's decline and stabilize currencies within unofficial target ranges. Together, Plaza and Louvre demonstrated that free-floating currencies were actually managed floats, with major central banks coordinating to achieve desired exchange rate outcomes. The mechanism had changed from maintaining formal pegs to intervening collectively in supposedly free markets, but the control remained. What really survived Bretton Woods' collapse wasn't the specific exchange rate arrangements, but the institutional infrastructure and the precedent for supranational monetary management beyond democratic accountability. The IMF evolved from exchange rate monitor to crisis manager with vastly expanded authority. The Bank for International Settlements deepened its coordination role, hosting monthly meetings where central bank governors coordinated policies away from public scrutiny. The G7 and later G20 formalized high-level economic policy coordination. Most significantly, dollar hegemony continued and even strengthened without gold convertibility. The petrodollar system created in 1974, through negotiations with Saudi Arabia and OPEC members, generated new structural demand for dollars by requiring oil sales to be denominated in U.S. currency. Countries needed dollars not just for reserves, but for energy purchases, deepening dollar dependence beyond anything Bretton Woods had achieved. Financial market liberalization in the 1980s and 1990s created enormous pools of dollar-denominated assets, making the dollar more dominant as a reserve currency in 2025 than it had been under gold convertibility. The dollar currently represents approximately 60% of global foreign exchange reserves, a higher share than during much of the Bretton Woods era. The 2008 financial crisis triggered calls for a new Bretton Woods that would reform global monetary architecture, but what actually emerged followed the established pattern. Crisis conditions justified expanded central bank coordination that became permanent. The Federal Reserve established unprecedented dollar swap lines with other major central banks, providing unlimited dollar liquidity to prevent global financial system collapse. These swap lines continue operating today, having transformed from emergency measures to permanent infrastructure. Central banks coordinated quantitative easing programs that expanded balance sheets by trillions of dollars, with the Federal Reserve's actions effectively determining global monetary conditions through dollar dominance. The G20 was elevated from technical forum to leader-level coordination mechanism, institutionalizing economic policy coordination beyond what Bretton Woods had attempted. Proposals for the IMF to issue special drawing rights as a global reserve currency re-emerged, reviving ideas from the Bretton Woods negotiations about creating international money beyond any single nation's control. None of these measures were unwound as the crisis passed. They became the new normal. Today, central banks are coordinating development of central bank digital currencies through the Bank for International Settlements, creating what could become a digital version of the Bretton Woods system with even more direct control over payment systems. The BIS Innovation Hub is is testing multinational CBDCs that would allow central banks to settle cross-border transactions directly without commercial banking intermediaries. This represents Bretton Woods 2.0 implemented through technology instead of gold pegs, the same centralized coordination of monetary power, updated for the digital age. The COVID-19 pandemic of 2020 triggered another round of unprecedented central bank coordination and monetary expansion that followed the exact pattern established at Bretton Woods 80 years earlier. Emergency conditions justified trillions in newly created currency, with central banks coordinating policy responses and purchasing government debt at scales that would have been unthinkable just months before. The Federal Reserve's balance sheet expanded by nearly $5 trillion in a single year. These temporary emergency measures show no signs of reversal, adding another layer of permanent monetary infrastructure justified by crisis. What becomes clear when you trace the arc from 1944 to today is that Bretton Woods wasn't really about the specific monetary arrangements of dollar-gold convertibility and fixed exchange rates. Those arrangements collapsed in 1971, yet the institutions created at Bretton Woods not only survived, but expanded their authority and reach. The International Monetary Fund operates with broader powers today than it possessed under the original system. The World Bank has evolved into a vast development bureaucracy managing hundreds of billions in lending. The Bank for International Settlements coordinates central bank policy globally through mechanisms undreamed of in 1944. Dollar dominance continued without gold backing, proving that Bretton Woods' real purpose was never about gold convertibility. It was about institutionalizing dollar hegemony through permanent structures that would outlast any particular monetary arrangement. The conference at the Mount Washington Hotel created the architecture for coordinating monetary control beyond national democratic processes, and that architecture strengthens with each passing crisis. The pattern repeats with remarkable consistency. World War II created conditions for Bretton Woods, which created permanent dollar system infrastructure. The Great Depression transformed the Federal Reserve from limited lender of last resort to active economic manager. The 2008 crisis expanded central bank authority to include quantitative easing, asset purchases, and direct market intervention. The 2020 pandemic normalized fiscal monetary coordination that erases the distinction between government spending and central bank money creation. Every crisis generates coordination mechanisms and institutional expansions that never get fully unwound. What central bankers needed Bretton Woods for wasn't post-war recovery. The Marshall Plan accomplished that through direct aid and investment. They didn't need it for exchange rate stability. The system collapsed within 3 decades. They didn't need it for development assistance. The World Bank's actual development impact remains hotly debated. What they needed Bretton Woods for was permanent institutional infrastructure that would give them coordinated control over international monetary affairs beyond the reach of national democratic politics. The genius of Bretton Woods was creating institutions and precedents that would survive the collapse of the specific system those institutions were supposedly designed to maintain. The IMF outlived fixed exchange rates. The World Bank outlived reconstruction lending. The coordination mechanisms outlived the formal rules. The dollar dominance outlived gold convertibility. The institutional architecture proved far more durable than the monetary arrangements it allegedly served. This reveals the actual function of international monetary agreements. They're not primarily about the specific exchange rate mechanisms or reserve assets they establish. They're about creating permanent institutional structures for coordinating monetary control that transcend national sovereignty and operate through technical expertise that excludes democratic participation. Bretton Woods perfected this approach, creating institutions that would expand authority through successive crises for the next 8 decades. Understanding this pattern empowers you to recognize it operating in every current proposal for international monetary reform. When you hear calls for a new Bretton Woods, for enhanced IMF authority, for coordinated central bank digital currencies, for global financial regulation, you're hearing the same playbook. Crisis creates the conditions for institutional expansion. Technical complexity excludes democratic oversight. Temporary emergency measures become permanent architecture. International cooperation serves as euphemism for centralized control. The lesson isn't that international coordination is inherently wrong, or that monetary management doesn't require expertise. The lesson is that crisis moments transfer power in ways that rarely get reversed, and institutional structures created under emergency conditions tend to expand far beyond their original stated purposes. Bretton Woods transformed a 3-week conference during wartime into 80 years of expanding monetary control through institutions that have repeatedly outlived their original justifications. The real revelation from Bretton Woods is this. It wasn't about fixing the international monetary system after World War II. It was about creating an international monetary system that central banks and finance ministries could control beyond the constraints of national democratic politics. The institutions, the coordination mechanisms, the dollar dominance, the precedent for supranational economic management, all designed to concentrate monetary authority in institutions that answer to no electorate and operate through expertise that ordinary citizens can't meaningfully challenge. Once you see this pattern, you recognize it operating today in proposals for addressing the next crisis, whatever that crisis might be. The playbook hasn't changed since 1944. Only the specific monetary arrangements get updated, while the fundamental architecture of centralized control deepens and expands. That's what those 730 delegates really accomplished at the Mount Washington Hotel in July 1944, while soldiers still fought and died on distant battlefields. They built the framework for monetary control that shapes your economic reality today, and they built it to last far beyond any particular crisis or currency arrangement. The Bretton Woods system collapsed, but Bretton Woods' purpose was achieved and continues operating through institutions that grow stronger with each new crisis.